In this week's tutorial, we're going to focus on two particular standards, IAS 37 and IAS 10, but we'll also have other standards thrown in as part of the two questions. So we're going to start off with question 1, which is RAI Limited, and you're told the net profit for the year of the draft financial statements show a net profit 585,000, but there's a couple of key issues. We have 4 key issues we have to deal with. And the question asks you in part A, discuss the appropriate accounting treatment, and where relevant, give journal entries. So when you're asked to discuss it, you should be referring to the relevant technical guidance, i.e. what the relevant international accounting standard is. And in part B, what impact will those 4 issues have and the adjustments you suggested on the draft net profit figure for the year. Okay, so let's start then with issue 1, which is to do with dividends. So you're told here, issue 1, an interim dividend was paid on the 1st of July, but at the board meeting they also proposed a final dividend of another 105,000, which will be approved at the AGM in January 2020 and paid in February, and no account has been made of any dividends. So the key thing here is IAS 10. That provides the guidance for dividends paid. The dividends paid are fine. They have actually been approved and paid during the year, but the proposed dividends should not be accounted for. You only account for dividends when they have been approved before the year end, and that's under IAS 10. So in this case, you're going to debit retained earnings, and you're going to credit bank 105,000. For the other final dividend is not approved until after year end. Thus, do not adjust under IAS 10. Should be IAS 10. Disclose only. So you only disclose it. That's the key thing with issue 1, is you know the guidance, which is dividends, IAS 10. Only if the dividend has been approved before the year end can it be accounted for in the accounts. If it hasn't, then it's disclosed only under IAS 10, events after the reporting period. The next one tells us on the 1st of January 2019, RAI sells one of its properties for 200 grand, and this was purchased 5 years earlier for 150,000, and the only entry made was to debit bank credit revenue. Now we know this is actually IAS 16, so you can get other standards thrown in as well. That's not how to account for the disposal of property, plant and equipment. We need to calculate the profit or loss on disposal and then reverse or adjust the entry that was currently made. So let's have a look at here. Disposal of PP is not revenue. Need to calculate profit/loss on disposal. So we need to calculate the profit or loss disposal. So here we have the cost, we're told, was 150,000, and accumulated depreciation. So what is the accumulated depreciation? Well, we have it for 5 years, and it's 2% straight line from date of purchase to date of sale. Well, it's easy here because it's the 1st of January, so you're actually not charging any depreciation in 2019, but you're charging it from 2014 to 2019, which in this case here will be 150,000 times 2% times 5 years. All 14, all 15, all 16, all 17, all 18. So 5 years depreciation. So the net book value at disposal will be 135,000, 135. And proceeds were 200,000. So clearly this is going to be a profit. You made a profit on disposal of 65,000. Now again, that's quite a basic adjustment, but that could easily be part of a bigger IAS 1 question, where you're given that note, you have to figure out what's wrong, reference the standard, IAS 16, and then give the appropriate debits and credits. So remember here, how we deal with a profit or loss on disposal, get rid of accumulated depreciation, the asset is now gone, debit 15,000, get rid of the asset cost account, credit 150, bring in the proceeds. Now this is where you go wrong. You're not debiting bank because bank has already been debited. Instead, you will debit revenue because that incorrectly credited 200,000. Now, if you decide and say, actually, I want to reverse this out completely and start from scratch, that's fine as well. You'll just have 2 separate sets of journals rather than doing one net set. Either one is fine, you come to the same answer. And then we credit the SOPL, the profit on disposal in 2019, 65,000. So again, that should be okay for the majority of students. Basic IAS 16, I threw in a couple of those as well to remind you, but it's no harm to practice. It's not revenue in this case because you're selling a property, plant and equipment, so it's IAS 16 disposal. And that's your issue 2 dealt with. Now don't worry, we'll come back to these again at the end and we'll deal with part B, the impact on profitability. Issue 3 then is to deal with a court case. So they're currently involved in a court case related to the injured employee while working in one of its quarries. And the solicitors think it's highly probable that they will be found liable for damages 60 grand. Both the company's insurance in place and they will cover all damages up to a maximum of 50,000. But the insurance claim has not yet been processed. No entries have been made for this. So this is clearly IAS 37. Remember the criteria here for a provision. What is the criteria? So the court case to be recognised must meet 3 key criteria. So in this case here, 1, it is a present obligation from a past event. So the employee got injured and they're now suing you. So it is a present obligation. There is a probable outflow of economic resources. What they mean by that is there's a probable outflow of cash. You're told it's more likely than not. It's highly probable. And finally, it can be estimated reliably. And again, you can see there, you can estimate it at 60,000. So because all of those 3 criteria are met, you can recognize a provision. You'll debit the SOPL, call it legal expenses if you wish, 60,000, and you will credit provision, most likely in current liabilities, 60,000, because the 3 criteria are met. Right. So again, we're looking for you to reference the relevant technical guidance and show your ability then to apply your knowledge by giving the debits and credits. Not a bad question, not a bad requirement, but don't forget, what about the insurance claim? Insurance claim of 50k has not been started yet. Can only be recognized, remember the key term, under IAS 37 if it is virtually certain. That's the key term, not in this instance. That means it is a contingent asset. Disclose only, no adjustment. Right, so that's a key thing you need to watch for in the questions is, if you need to comment on each aspect, it's one thing dealing with the court case, you need to also comment on the insurance claim. That's money possibly coming in. But the fact that it hasn't been processed yet, yes, they say it's likely, but the point is it has to be virtually certain. There's a different threshold for inflows than there is for outflows. And again, that's a key part of IAS 37 as well. So you had the claim, the court case itself, which did meet the criteria provision, and then you had the insurance claim, which didn't meet the criteria to be recognized as an asset. That means it's called a contingent asset and it's disclosed only. The last piece then is issue 4. So issue 4, you're told on the 1st of the year again, the company purchased a gold mine for 1.5 million. But a condition of running the mine is that they have to restore the mountainside to its original state when the license expires in 6 years time, apologies. The estimated cost of restoration is 600 grand at the end of the project. And the mining commenced straight away, and the relevant discount rate is 8%. So this is a combination of IAS 16 plus IAS 37. It's what we call a capital provision. So it's a provision here that's going to take account of time value of money, because you do have an obligation to restore the mountainside, but it's not for 6 years. So when you recognize it today, you'll be recognizing at its present value, this thing called the capital provision. So the first thing, there's no account made, so we're going to debit PP, the 1.5 million. That's the easiest starting point. How much you bought the mine for, and you credit bank. That's one of the easiest starting points. You debit PP, you credit bank, just for the amount paid for the mine itself. However, we're also going to debit PP and credit a provision for the restoration. So if you want to call it provision restoration or some variation of that, similar to what you might have with quarries, what you might have with chemical factories, etc. You're going to recognize this at the 600,000 at its present value, divided by 1.08 to the power of 6, because the 600,000 is in 6 years' time. IAS 37 says if time value of money is material, you need to account for it. And it will be material here. It's going to have a significant difference whether it's 600,000 in 6 years' time or the present value today. So that will be 378,000. That's the present value today. And you're allowed to capitalize that under IAS 16. The cost of decommissioning or the cost of restoration is allowed to be capitalized. I'll just put there 600,000 divided by 1.08 to the power of 6. Now, you are allowed to use the time value of money tables, the present value tables if you wish, but they will be together. So PPE in total on the 1st of January 2019 will be 378 plus 1.5 million. All right, so that's going to be those together. Just tidy up that so it's easy to see. So it's 1.8 million. And then don't forget you charge depreciation. Depreciation over its useful life will be 6 years. Again, we'll tidy that up. So you're actually going to depreciate the restoration cost as well. So that's your 6-year life. So don't forget to charge depreciation, debit SOPL, credit accumulated depreciation. 313, 313. So there's a lot of moving parts there. You had to recognize the original mine cost, recognize the present value of the restoration cost, and then don't forget to depreciate. And the tricky one, and this is the one that catches students out at the end, this restoration will increase each year. The provision will, because it gets closer to the payment date. So at end of 2019, we need to what we call unwind the provision discount. What we mean by that is it's now no longer 6 years away. It's now going to be 600,000 divided by 1.08 to the power of 5. So you're getting closer. So the updated provision here is 1 year closer. And this is accounted for, and we looked at this in class in IAS 37. It's going to be 600,000 divided by 1.08 to the power of 5. So it's actually now 408,000. At the start of the year, it was 378, now it's 408. And that increase, the difference, is what we call the unwinding. Over the next 6 years, you're going to build up that provision to the 600,000. You're going to debit SOPL, finance costs, credit the provision for restoration. So you're bringing the provision up now by 30,000. What we call that is the unwinding of the discount. So under IAS 16, you only ever recognize its initial present value. You don't change property, plant and equipment once it's initially accounted for. But under IAS 37, you must account for that. You must account for that each year. As it gets closer and closer to the actual payment of the restoration, you then need to unwind it, and it goes through finance costs because you're saying that's accounting the time value of money. Now that is tricky. That's what we call a capital provision under IAS 16/37. So that's our part A, the key journals. Part B, your draft net profit is 585,000. And this is why you're asked here, is to see the students understand where do the debits and credits actually go? Which financial statement do they go to? So we come up and we look at each issue. Be careful, issue 1 has no impact on profits. Dividends never go to the P&L profit or loss statement. They go straight to the statement of change in equity. So no issue or problem in issue 1. Issue 2, we have 2 adjustments. We have debit revenue. Now we're ignoring tax here. So that means that's going to reduce revenue by 200,000. That will reduce profits by 200,000. And we're crediting the P&L 65, which is the profit on disposal. So if we come here, we have our revenue, and you just cross-reference revenue, issue 2, profit, issue 2. This is plus 65, this is minus 200. So again, you're just showing the examiner where you cross-reference them in, and you know what issue they're coming from as well. Again, we're knowing the impact on tax here. Issue 3, that's going to be debit the SOPL. You're increasing your expenses, you're decreasing your profits. So we call that the legal provision, and we call it issue 3, and that is 60,000 minus. Because expenses go up, profit goes down. So it's a bit of a tricky one that you should watch for to understand the impact the journals have. And then on issue 4, we have 2 impacts. We are depreciation for the year, 313, and we have finance costs to do with that tricky unwinding of the discount. The present value is getting closer as the years progress. So here we saw the depreciation, issue 4, and we have the unwind, issue 4. And that will get us the updated net profit. So it's all nice and neat, well laid out. So depreciation will be a negative figure because it's increasing the expenses, and the unwinding will be a negative figure as well. Now just tidy those up that they're all the same. Just make sure all these are the same. And that gets us an updated net profit at the year end. Instead of 585,000, it's actually only 46,735. So just be careful and watch for those types of questions where you might be asked the journal entries, but what impact that will have on profit. And that's a typical one, remember, in IAS 1, where you'll be doing the journal entries for each note. But then you have to remember to bring each of those journal entries to the relevant financial statement. And all of those entries here would have gone to the statement of profit and loss for RAI in the 31st December 2019. So when you're asked to account for it and explain the treatment, we're not expecting big essays. You reference the standard, brief explanation, give the journal entry, and you move on. That's more than sufficient to get your full marks in any exam question. So we're now going to move on and look at question 2, which is Yelkin Limited. Again, a similar enough issue, a structure to question where you're asked to prepare the necessary journal entries to account for the above issues. And with respect to IAS 10, the rationale behind your journal entries for items 1 and 2. So we'll do A and B together as they come. We'll explain them as they go along. So we're essentially asking for the same thing for 1 and 2. So look at question 2. All of this is revolving around predominantly IAS 10. Financial statements for the 31st December 2018 have not been authorised for issue yet, so we're still within that IAS 10 period. And you're told here after the year end, the 1st of January 2019, a fire destroyed plant carrying value 140. Yelkin has an insurance policy to cover the fire damage, and they made the following entry in 18. They expensed insurance loss, they debited trade receivables, so the money coming in, they credited property, plant, equipment to get rid of it, and they credited deferred income. So the key thing here at issue 1, because we can explain it because that's part of part B as well. So we're doing A and B together. Issue 1 is under IAS 10. This is a non-adjusting event. So it's one of the clear examples that's given in IAS 10. It does not give more information about a condition that existed at the year end. So no adjustments should have been made at the year end. Disclose only. Assuming material. So assuming that this was material, you disclose it only. You don't make an adjustment because the fire wasn't there at the year end, right? So that's a clear example, a very explicit example in the standard that you don't make an adjustment before the year end. And that's what we're looking for you to use that language, reference IAS 10, mention it's a non-adjusting event, and say they were incorrect there. So you're going to credit the SOPL, insurance loss. You're going to credit trade receivables. You're going to debit PPE, and you're going to credit deferred income. So you're going to debit deferred income, should I say. You're just reversing it out, a full reversal of the entry because it shouldn't have been made in the first place. And debit PPE and debit deferred income. Now, it will be adjusted for in the 2019 accounts, but you're not asked for that. You're asked for the year end, if you come down here, 2018. So you're only looking at the journal entries required for the 2018 accounts. So the next one we're told relates to Yelkin's trade receivable of 9,000 was owed at the year end. The customer was declared bankrupt on the 8th of January, and they have no expectation of receiving any money, so they decided to net the write-off against the general allowance. That's what they've done at the year end. Now this here, the post-year end bankruptcy of a customer, is an adjusting event. So again, it gives more information about a condition that existed at the balance sheet date, i.e. the trade receivable health at the year end. So in our case, well, if they went bankrupt 8 days later, it's likely they were bankrupt at the year end. So you should have written it off. It's an adjusting event. Need to write off the trade receivable. And you're writing it off in full here because you're told you're not going to receive anything. So you shouldn't have written it off against the allowance. You should reverse that, credit the allowance for bad debts, 9,000, and you will debit bad debt expense in the SOPL 9,000 instead. So that's the rule, and that's a clear, explicit example in IAS 10 as well. The post-year end bankruptcy, or for example, the post-year end sale of inventory at a price lower than cost, that's also indicative that inventory is written down at the year end. So they're two very popular examples you'll see in a lot of exam questions as well. It's an adjusting event. It gives you more information about the state of that asset, be it inventory or trade receivables, at the year end. All right, so that's our issue 2, and we've explained it as well as was required in part B. Issue 3. So these are good little small examples to test your knowledge of the standards. A sale of 200,000 was made to a major customer. The customer has since notified Yelkin that they are unhappy with the goods and that they've arranged the goods to be returned and refund in full expected. But Yelkin has another customer who's going to take those goods and sell them at full price. So there's going to be no damage or loss really overall. And what Yelkin want to do to be prudent is they have debited cost of sales and credited a refund at the year end. Now again, the key thing here is this sale took place after the year end. Thus, nothing to do with 2018 accounts. So in this case, this is a non-adjusting event. The return is a non-adjusting event. The sale is a non-adjusting event. It's nothing to do with 2018 accounts. If the sale took place and you might think, well, I expected the return to come back, you might adjust for it. Whereas here, nothing relates to 2018. So they're incorrect to make the adjustments in 2018. You're going to credit cost of sales, 200,000 to reverse it. Bring that over. And you're going to debit refund payable. Because again, that shouldn't have been met at all. It actually had nothing to do with that year. All of those transactions in that condition was after the year end. So just watch your key dates to make sure you don't make a mistake in them. And that brings us then to issue 4. And this is the one I mentioned earlier, which is similar enough in concept to issue 2. Inventory costing 12,000 was found to be close to perishable date at the 31st December. And 5 days after the year end, in that IAS 10 period, it was sold at a discount of 30% on its normal selling price. Its normal selling price is based on a markup of 40%. And what they've done is they've debited inventory and credited cost of sales 3.6. So they've increased inventory, recognized at 3.6, and they have credited cost of sales, right, which again is reducing cost of sales. So we're saying that doesn't really look to be the right answer. So what we want to say here is the post-year end sale of inventory gives more information about inventory at the year end. So this is an adjusting event. It's an adjusting event because it gives you more information that this asset might have been written down at the year end. So its cost, we're told, 12,000. Now this is where some students are going to get caught. Their normal selling price. The normal selling price is 12,000 times 1.4. Remember, based on a markup of 40%. Normal selling price, 16,800. Actual selling price is 70% of that. 30% discount. Some students would have just seen the 30% discount and took 30% off the 12. That's not what they're telling you. They're telling you it's a 30% discount off the normal selling price. The normal selling price here would have been 16,800. So that means they sold it for 11,760. So that means the NRV is less than cost. And the difference here is 240. That's your adjustment. Now that was quite tricky. Some students would have got mixed up with the 30%, or it's the lower of cost in NRV. And the fact that you sold inventory, even though it's after the year end, that's a clear example of what we call an adjusting event, because it gives us more information about what the NRV would have been 5 days earlier at the year end. The NRV is lower, so this is actually related to IAS 2. Lower of cost and NRV. So there's a link here. That's a very common one in IAS 2. IAS 2 and 10 together. You're going to reverse this, reverse the entries, because they are clearly wrong. Credit inventory, current asset, debit cost of sales, 3636. The cleanest thing is always to just reverse the entry if you're ever in doubt. And instead, what you're going to do is you're going to reduce inventory, current asset, bring it down by 240, and debit cost of sales, 240. So don't forget the entries that are already there. You need to deal with those first. You can try and do it all together, and you can debit one single debit to cost of sales, one single credit, or you can do them separately. Either one is fine, and you get full marks either way. But that issue 4 is quite similar in concept to issue 2. Things happen after the year end. People go bankrupt. Inventory gets sold at a lower price. That gives you more information about those assets at the year end, and therefore you'll write them down to the respective carrying amounts. All right, so that is question 2. They don't ask anything about net profit or anything like that, and we've already explained part B as we've gone through the question. So that was the tutorial for this week, focused particularly on IAS 37 and also IAS 10.